Good afternoon. My name is Robin John of Wellden Turnbull, and I'm going to talk to you this afternoon about the Chancellor's budget that we heard earlier today. The first thing is that Chancellor spent a lot of time telling you how they're going to simplify the tax legislation. When I started doing tax about 30 years ago, a compendium of tax legislation was about this size. Well, last year, this is the compendium of tax legislation. I'm not going to pick it up because it's far too heavy. But every year it's gone up and up and up steadily. Is it going to be smaller next year? I doubt it. It never has been in all the years that I've been doing tax. The first thing I want to cover this afternoon is something of potentially great importance to many entrepreneurs, and that is the rate of tax on dividends. If you look at this table here, you'll see a comparison of the present rates with the proposed new rates. The Chancellor said before the election that he did not propose to increase any of the rates of income tax. Well, arguably he hasn't increased the rates of income tax. But what he has done is to take away the tax credit attaching to a dividend. In the past, the rate of income tax on a dividend was 10%, but because the dividend carried a tax credit of 10%, for a basic rate taxpayer, there was no further tax to pay. Now that's going to change. There's a tax-free allowance of £5,000. The balance is taxed at 7.5%. That might sound like less than 10%, and it is less than 10%, but the difference is you actually have to pay it, whereas the 10% you didn't pay it because it was covered by the tax credit on the dividend. If you look at the effective rate of tax suffered by an entrepreneur who earns his profits through a company, on each £10,000 of marginal profit, you can see the effective rate of tax under the new regime and under the old regime. For a basic rate taxpayer, his total tax burden would be 20% now. It will be 27.5% under the new regime. For a high rate taxpayer, it goes from 40 to 46%, an additional tax rate taxpayer from 45% to 50.5%. Those rates will come down by a couple of percentage points because of the proposal to reduce the rate of corporation tax to 19% and then to 18%. It's still slightly less than the rate of tax that will be paid on a salary plus national insurance contributions. You'll see those numbers in the right-hand column here. The basic rate of tax is 40% if you take into account the national insurance contributions, 49% and 53.4%. There is therefore still a saving from the entrepreneur paying himself by way of a dividend, but it's not as great as it was, and that's deliberate. There's very little saving from a company as opposed to a sole trader now, but of course the advantage of trading through a company is money left in the company to finance your assets and your working capital is still taxed at the lower corporation tax rates rather than the higher income tax rates. One area where changes were predicted was in relation to non-domiciled individuals. There's been a lot of publicity about this, been a lot of allegations of unfairness. The Chancellor says that he thinks he's going to raise about £1.5 billion through these changes. I don't know where he gets that number from because, of course, the problem is he doesn't know what the income is of non-domiciled individuals who are taxed on the remittance basis. Nevertheless, just to remind you of the present position, a person who is not domiciled in the UK, but nevertheless resident in the UK, can elect for his non-UK source income and gains to be taxed on the remittance basis. That is, they're only taxed if and to the extent they're remitted to the UK. If you make that election, for the first 7 years, you give up your personal allowances. After 7 years, you pay £30,000 for the privilege. After 12 years, you pay £60,000, and the proposal is that after 17 years, that will go up to £90,000. Well, the latest proposal is that after a person has been resident in the UK for 15 out of the last 20 years, he is deemed to be domiciled in the UK for all UK taxation purposes. That means he will be taxed in the UK on his worldwide income. If he then leaves the UK, he remains deemed domiciled in the UK for 5 years. In practice, that only makes a difference for inheritance tax purposes because, as you will recall, if you're resident in the UK, you're subject to tax on your worldwide income. If you're not resident, you're only subject to tax on your UK source income. But if you're domiciled but not resident, you're still subject to inheritance tax on your worldwide income. The other change, which had a lot of attention because of, I think it was the chief executive of HSBC, who was born in the UK, moved his domicile to Hong Kong, became resident again in the UK, and claimed he was still domiciled in Hong Kong. In future, if you fall into that category, you will be deemed to be domiciled in the UK when you become resident in the UK again. This will also affect any assets that such a person has settled in an offshore trust. Obviously, if that doesn't involve you, you probably won't be interested, but if it does, then you'll appreciate that's a very important point. Another target for the Chancellor is inheritance tax on foreign-owned property. If an individual or a trust owns property in the UK, then it's subject to UK inheritance tax. To get around this issue, what a lot of foreign individuals or trusts do is to own UK property through a foreign company. In that case, the asset that the individual or the trust owns is the shares in the foreign company and not the UK property. They now propose to have look-through provisions, which will apply where residential property is owned by an individual or a trust through a company. In cases like those, he proposes to bring that within the charge to UK inheritance tax. We haven't yet seen the details, although it has been suggested that these will closely follow something called the ATED rules, the annual tax on envelope dwellings, but with less exemptions. It may be a good idea for people to start thinking about restructuring arrangements. The rules apply with effect from April 2017. In particular, it's important to look at when you acquire a property as to whether you can structure it so as to reduce any potential inheritance tax, possibly by charging debt against the property. Obviously, we'll have to wait until we see the detailed legislation before we know what we can do about this. The good news is it doesn't affect other excluded property, that is, anything that's not UK real estate that's held in an offshore company or trust. One tax change that will affect UK trading companies is the rules regarding depreciation on goodwill. Since 2002, companies have been able to depreciate goodwill that they have purchased. From 8th of July 2015, that finishes. Companies can no longer depreciate goodwill that they have acquired unless they did so before the 8th of July or pursuant to a contract entered into before that date. I have to say this does seem unreasonable. Goodwill is an asset of the business in just the same way as an item of plant and machinery is. Allegedly, this is to place the purchase of goodwill on the same basis as the purchase of shares, but I'm not convinced that that's a good reason. Nevertheless, unfortunately, from the 8th of July 2015, goodwill will no longer be depreciable for tax purposes. The final change that I want to cover relates to buy-to-let landlords. At the moment, buy-to-let landlords are taxed on the profit that they make on renting out their property. They can deduct any expenses. That includes interest on money borrowed to purchase the property, or perhaps slightly generously, money secured on the property even if it's used for another purpose. In future, that interest will only be relievable at the basic rate of income tax. This change is to be phased in over the next 3 years, and it's fully effective from 2020-21. Obviously, the basic rate of income tax is the same as the rate of corporation tax, so there's no advantage in terms of tax relief for a company as compared to an individual. But it potentially will significantly change the economics of buy-to-let property for the larger buy-to-let landlord. That's all I've got time for this afternoon, although you will appreciate the Chancellor covered a number of provisions that I haven't been able to cover this afternoon and I'll have to deal with at a later date. You will also appreciate that what I have said this afternoon is based upon the press releases that have been issued, so the final provisions may be slightly, or in some cases substantially, different. Thank you for listening.